I know Jan mentioned earlier, in the introduction about, international investors investing in the UK. And it's quite a good subject actually, because there's a lot of interest in overseas investors in the UK at the moment. And to be fair, before COVID, there was more again because they were seeing a massive opportunity in the UK market. The yields are like no other. They don't get the yields that they get in the UK at home a lot of the time. And also their financial systems aren't always as secure. Not just that, their lending avenues are not as sophisticated. The buy-to-let mortgages aren't. I mean, even if you go to France, they don't have affordability on buy-to-lets like we do, where we're looking at it just on, the rental of the property that you're looking to finance. So even in France, which is it's a more economically developed country, just like we are, it still doesn't have that sophistication when you're looking at buy-to-let mortgages, for example. So I work with a lot of overseas nationals. I'm actually going to Singapore in June. I'm doing some training, very much like I am tonight, but over a couple of days, with around 100 investors who invest in the UK. And a lot of them are interested in the UK still, even though over the last couple of years, they've got a levy on their stamp duty. They pay an extra 1% than we do. And often lenders charge them more on interest rates. They can't go to lenders like Kent Reliance, TMW, lenders that you've all probably heard about. But even lenders that they can go to will charge them an extra 1% on product fees. So it can be very expensive now for international investors to invest in the UK. Now, it's actually a great opportunity for us as investors that might be looking for joint ventures. We might be looking to do flip projects. We might even be looking to hold portfolios with investors. I even deal with people in Singapore, Hong Kong, Dubai that put together property clubs where there might be a limited company and there could be like, over 6 of them or more in that limited company as shareholders, all holding, a minimal shareholding. And the key thing with that property club is that you've always got one majority shareholder in the UK that's a director that is responsible for the mortgages and also the deals on the ground. Of course, if you're living overseas, it's not so easy to do deals, view deals, and carry out refurbs and project manage. So what we're looking at now here on this slide is the Basel Index, and what you're seeing is the world map. So we got a Richter scale there, and where you see the red zones, they're the countries where funding is more difficult to do in the UK on UK property, where we're using deposit money from these red zones. So actually, don't be disheartened, because if you're looking at working with investors in the red zones, the amber zones, some of the darker oranges there, we've actually successfully still done loans with those funds used as deposit sources or refurb monies, and then been able to get mortgages or bridging finance for the difference. And that's quite significant because even in Russia, we've managed to use, funds from Russia, even with what's going on, where they will have moved certainly up that scale and used those as deposit funds, or even been able to refinance a property that's been purchased with Russian money, for example. So we're still able to do the high risk areas, but what that means is lenders drop out. It makes it more difficult to get funding if they originate from high risk areas. So it's actually a great tool if you're looking to invest overseas with people overseas. And you can find the Basel Index map online, and it's an annual ranking for anti-money laundering, basically, global. So moving on then to private investor loans, if anyone's using private investors at the moment, what will lenders want to see? So, of course, you'll have a loan agreement between yourself and the investor where it will detail the term of the loan. It'll detail what remuneration the investor will get for the loan. And that will give the lender some security that there is some provisions in place and an agreement so that if anything broke down, that you have that agreement signed. Now, when you're looking for private investors, of course, it's sometimes difficult to get people to lend you money. Of course, you might not know them, you might be building that relationship, but what you can really offer them to give them that added security within yourself to invest in you, you might offer them a personal guarantee. And that personal guarantee might be that, you're personally liable for the debt. And of course, if you've got equity in your home, it then increases the value of that personal guarantee. Of course, if you're an individual that's got no assets, no equity, then a personal guarantee isn't probably worth the paper it's written on, unfortunately for your investors. So it might not be such a strong offering, but nevertheless, it's still an offering because you're still personally liable. So you might use your personal guarantee as a negotiation tool to try and get investment. But also you might offer your investment an investor an undertaking to give them a second charge. Now, of course, we can't always give an investor a first charge, because if we're offering them a first charge, that means that we can't then get a first charge bridging loan, or it makes it then difficult to exit the deal because it could leave you short on funding. Some people often use RX1s or unilateral notices, and because of that, sometimes people are able to negotiate lease options. An RX1 is the typical document you might use for a lease option, and a unilateral notice is another form of a restriction. So we can use these documents for things like lease options, assisted sales, things like that. But of course, do speak to your solicitor if you're considering using any of these legal documents for your deals, because they will carry some risk. And of course, a charge is also probably more watertight than the latter. So yeah, just some lenders there that you probably use amongst investment funds. So at the moment, bridging is probably a great topic to talk about. What we've got at the moment is a very strong market of bridging finance. Now, bridging sometimes had a bad run of reputation, especially in the early days, you know, 90s and before then, where bridging loans were very expensive and the market was quite volatile. So what happened was some people were trapped into bridging loans, and some of them had their properties repossessed. But what we're actually seeing now is bridging finance being cheaper than it's ever been, especially if you're comparing it against mortgages. So as we've seen over the last 2 or 3 years, mortgage rates have massively increased. The base rate has gone up, you know, 4.5% at least in some times. So what we're also seeing is bridging finance hasn't really grown in cost very much. We've seen it grow about 0.1 per month, which is in the annual maybe 1.2 tops, in some cases not even that. So in comparison to how much mortgages have grown in cost, bridging is actually very cheap at the moment. So we're in a time now where property prices have stabilized a bit and bridging finance is cheap. So if we're at a time where interest rates are now going to come down, and therefore property demand is going to go up and people are going to want to buy more properties because they've got more access to funding, then I'm not saying it will happen, but it's quite possible that prices could escalate again. And we could find ourselves in a situation where we could get some cheap finance now in comparison to mortgages on a bridge, cheaper than it's ever been, and then maybe looking to exit at an escalated sale price. So flips could be a really good time now. I'm not saying they will be, but you know, if that did happen, you know, one would think that they are. So then in terms of bridging finance overall, if you've not heard about bridging finance, it's just a form of short-term funding, very different to a mortgage where it's a long-term form of finance. Bridging is charged monthly. Aside from bridging, mortgages are charged annually. So we use bridging a lot of the time when properties are inhabitable, because of course to buy a property on a mortgage, it needs to be habitable. You need to be able to live there. It's got to have running water, no damp, free of structural issues or impediments. And we can use the bridging therefore to buy properties that are a bit tired and might have damp, structural issues, and we can use it for acquisition. Now, we can also use bridging finance as a pre-planning measure. We can use bridging for title splits, where you might be buying a block of apartments, where you might be looking to then split the title, sell some off, maybe look to retain a few and retain the freehold. A lot of people have that type of strategy. Now, bridging is available for 1 to 36 months, and we shouldn't really look to stay on bridging for very long. It's really a tool that you should use to make money and not have it reduce your profit. And of course, for that, even though bridging has never been cheaper in comparison to a mortgage, it's still more expensive than a mortgage, apart from in some cases where you're looking to quickly refurb and refinance a property because mortgages have exit fees a lot of the time. So we can also use bridging to buy land, albeit at a lower loan to value. On properties, we're seeing about 75% loan to value, and on land, we're seeing about 60% and below in loan to value if it hasn't got planning. So using bridging, a lot of people sometimes have used it as an experience vehicle. You know, I've had overseas investors who've not got any experience or footprint in the UK, and they're able to buy a 36-bed HMO without any experience at all. And because bridging finance lenders are asset-based lenders, they're more interested in the asset. We call this non-status lending. So if you have adverse credit or no experience, it's not so much of a factor. They care more about the exit, which is why it's in red. So bridging being short term, the most important thing there is the exit. Now, aside from just lending money towards the purchase, we can actually use a pivot of bridging finance called refurbishment loans, where we can then borrow 100% of the works cost as well in some cases. Now, there are some guidelines that we need to hit. We need to have sometimes a minimum profit on cost of 15%. And usually refurb and development lenders will not usually lend you anything more than 75% of the end value. Now, when we're talking about development, we often see the end value being called the GDV. Now, the GDV is gross development value. It's just a posh word for end value for anyone who's wondering. So with bridging finance then, instead of paying that annually like we do on a mortgage, they charge it monthly. And there's two ways in which we can repay that interest. We can either service it and we can then pay the interest monthly, or we can deduct that interest for the whole term. So let's say that your bridge is going to cost you £1,000 a month and you've got a 12-month bridge. Then they might take £12,000 off your initial loan size to take the term of the loan there straight up front. So looking at some bridge to let, which can de-risk your concerns with bridging and still enable you to do the buy, refurb and refinance strategy quite well, is we can use a bridge to let tool. Now that is a bridge and a mortgage in one, which means that the value will go to the property and they will give you a gross development value on that property. So when you're going in, they will look at the schedule of works that you're estimating on the property, and they will compare that to the property as it is now against the purchase price. And then they will give an estimation to what they think that property will be worth at the end. So with bridge to let, instead of bridging finance, you usually see a cheaper product fee. With bridging, it's usually 2%. With bridge to let, they can be as low as 0.75 with Precise. And they're actually doing medium type refurbs too, which can include some structural changes there as well. So what that really does, I think the benefits of bridge to let is it gives you more certainty. Because of course, if you pay your valuation fee for a bridge to let and your valuer doesn't think that the property will be worth what you think it's going to be worth at the end, then you can pull out at any time. You can also exit at 80% loan to value, which includes HMO deals too. So if anyone's out there looking for maybe smaller HMOs that are not so commercially valued, then we can do that with an exit at 80%, which can be quite lucrative and will sometimes enable you to get all of your investment back out. So the only thing with that is that it will require local searches, which can slow you down on the bridging side. Not all bridging lenders will want local searches. Now, depending on your local council, some local councils are taking 6 weeks to return searches, which can really delay the process. If you're buying at auction and you've got just 28 days to complete, having then a 6-week period where you're going to get searches back alone extends your legal process without your finance application to beyond your 28 days. So you've got to be careful really when you're buying at auction what products out there that you're looking for, because sometimes you might need a lender that has an indemnity policy, means that they don't need the searches and they can just cover that off with an insurance policy. So if you're then lending money for development, it's a bit of a different process than bridging a loan. They're going to lend you money towards the purchase, and then they're going to lend you money towards the works as well. Now, with that, they're not just going to give you all of the money for the works up front. The way that works is that you'll need to get a main contractor, you'll need to get a contract in place with your builder, and the main contract you'll probably use will be a minor works contract. And you can get these from jctlimited.co.uk. They're called the Joint Contract Tribunal. And they're the prolific contract holders when it comes to development. So what happens is before your funding is released, you'll have a quantity surveyor or an asset manager involved where they will assess the development, they will assess the schedule of works and your JCT minor works contract, and they will set up a drawdown facility with your lender. For example, if you've got £100,000 worth of works to do on a development, you might break that down into 4 stages of 25,000. And before the lender pays any phase, they'll want to see that each phase is completed. So in phase 1, if you were going to be doing, your groundworks, or in some cases, you're going to be doing plumbing works, depends on what phase 1 looks like, they will expect those works to be done before they'll pay that invoice of 25K. And what that means is that either your main contractor is going to have to fund the first phase, or you're going to have to fund the first phase yourself. So it really just depends. It's funded in arrears. So with a drawdown facility, then you've got your JCT contract, your asset manager signs it off, you complete phase 1. Then you go to phase 2, sign off, and then you repeat that all the way until completion and exit. So a bit of an extra then with development funding. You can get stretch senior development funding, which is around 0.9 a month. They'll go up to 90% of the loan to the cost of the whole project. So they'll still want to see you or your private investor sitting at the outside funding 10% of the gross cost of the whole scheme. Another guideline is the loan wouldn't be more than 75% of the end value. You can then get mezzanine funding. Some developers run out of money, things get more expensive, finance creeps up. And if that happens to you, you can then get mezzanine funding, which goes up to 95% loan to the cost of the scheme. So mezzanine funding is named because it sits as a higher charge. It could be a second charge or a third charge, and that's why it's called mezzanine funding. Costing quite expensive at 1.5% per month, but it can stop you losing the development essentially. There are some equity lenders out there as well, which do a profit split. They'll fund 100% of everything, the purchase and the works. Now, for that, they'll charge a handsome interest rate of 1.5% per month, and they will also want 50% of the profit. So it's not an attractive scheme. So if you do see those out there, be aware that they're probably only really suitable for builders out there that don't really have much business acumen. Anyway, if you are doing developments and you're looking to sell those off, and you need to exit your development funding, you can get what's called a developer exit product, where they'll lend you 75% of the development, and you can get that on tier 1 bridging, which is between 0.74 and 0.79 per month. So then looking at residential mortgages is quite relevant, because residential mortgages are the cheapest money you'll ever get. It's the most tier 1 funding that you'll ever see. So with residential mortgages, I always get a lot of people coming to me with loads of equity in their home, and they're sooner going to want to lend money from a private investor at 1% per month, which is 12% in the year, or they'll take a buy-to-let or a bridging loan out. And I always wonder why, because if you're borrowing money on your residential mortgage, of course, you're personally liable for that money. And if anything went wrong, you'd lose your home. So I understand where it comes from. But if you did a loan with a private investor, or you did a bridging loan and you've got a personal guarantee on it, your home's really at risk anyway. So we need to really point that out. So it would actually then reduce the risk of your development by taking out money on a residential mortgage first, because the interest rate is a lot less and the setup fees are a lot less. Now, taking this from a financier who makes a lot more money from bridging and development, residential mortgages are a lot cheaper, and I make less money from these. So it's true advice from me. Now, we can actually exercise extraction of equity from your residential home by remortgage, a further advance if you've already got a mortgage in place. Now, if you don't have the affordability for that, we can do a second charge term loan with lenders that have a higher loan to income ratio, and they're still cheaper than private investors a lot of the time. So even if you've got bad credit, we can still look at doing things there, and we can just exercise the equity in your home so that you can reduce your overall cost of borrowing and essentially make more profit. So just a little example there of a second charge and how that works. If you've got a value of 600K, mortgage of 110, and let's say you can get a 65% loan to value second charge. That means that your maximum facility will be 390. Taking off the 110 you also currently have outstanding leaves you then with 280k that you can then invest. Of course, you need consent from your first charge lender. Now, this is an example of a longer term second charge, which would sit alongside your mortgage, less setup costs. They're only charging you a lender fee of 595. We don't really see fixed product fees anymore. We usually see them percentage based. So it's quite rare that we see these. Now, the rate on this would be 10.7, but a lot of people are paying 1% a month to private investors, and there's some legal costs as well in with that. So if we divide that 10.7 between 12 months, you've got 0.89 a month, which is controllable by you without any exit fees, no legals. They'll do a desktop valuation. And there's a little illustration there of what that would cost you for 60,000. So no product fees, no product switches. Now, probably the most important thing I could give you from this talk is if you're taking out a buy-to-let mortgage or a residential mortgage, make sure it's with a lender that gives you a product transfer at the end of your fixed term. Because if you take out a 5-year fixed or a 2-year fixed, and you then are going to go on the standard variable rate, it's going to shoot up to like 10% if you don't act and switch to a new rate or remortgage. Now, the thing is, if you don't have a product switch, you then have to remortgage where you're going to pay broker fees again. You're going to pay valuation fees again. You're going to pay legal fees again, and the full product fee on the loan size all over again. Now, what we see is with buy-to-let mortgages, a lot of specialist lenders are not giving product transfers. Now, product transfer is great because if any of my customers come back to me and they say that I'm coming to the end of my fixed term in a couple of months, can you do a product transfer for me? I'll say, yeah, no problem. I'll do it free of charge because it doesn't take me very long. It's 10 minutes on an application and it's done. So I don't actually charge for product switches. I do them on behalf of my clients for free. And there's no legal charges, there's no valuation, there's no underwriting, no broker fees, and the product fees are usually very much discounted from what your existing lender will charge a new business customer, for example. So it's very lucrative to be able to have a product switch. Now, Kent Reliance is actually a lender that has product transfer facility. I've got about 9 mortgages with Kent Reliance. Brilliant lender, pretty much because when I did a lot of investing, they were the cheapest lender that didn't have a 6-month rule. So I was able to buy a property, refurb it, and then quickly refinance with Kent Reliance on the new value to get all my money back out. So at the moment, this is an example of a HMO purchase that we're doing, and it's with a property with a valuation of 180k, and we're going for a 75% purchase. So 135 is the net facility there. The gross loan is higher than that because they've got quite a high product fee on that, and the rate is 5.09. So the cost of that will be £603 per month, and that's for a 6-bedroom HMO. So the gross rental on that is just over 2,500. Residential valuations with comparables. Again, this one's not inside Article 4. And actually the client didn't want an investment valuation or a commercial valuation. So when we then deduct the mortgage and the bills of 1,200, let me just move this over here. We've got a net amount left over then of 747 per month. So the ROI on that, including the product fee and the stamp duty, is still over 15%. It's a buy and go. Now we're going to look at how we would then take more money out of this property when the value rises, because we can still do a light refurb within a mortgage term. It's not against mortgage guidelines, especially if you ask for permission. But also a light refurb isn't anything structural, and most lenders will give you permission for that. So looking then at the further advance facility, with Kent Reliance, we can get a further advance with them. The minimum further advance changes all the time. So we've actually got an exception for this one. But anyway, the client has managed to raise the value of the HMO then to 220 by a light refurb. They're looking to now take a further advance, 80%, which means minus their current loan, that they've already got with Kent Reliance, they can then take out another 33,625. So we're going to now see how that impacts the return on investment. They borrow more money, of course, but they've managed to slightly increase their rental as well. So for the further advance, there's a 2.5% fee on the advance. So we've also going to include that product fee in the return on investment as well and add that in. So it increases then the cost of the finance by 192 per month. The rental now is at 3,000 per month, a bit of added value there. So the net return on investment, including the further advance, the monthly bills at 1,200, is 12,060. So the investment is now reduced to 24,990 because, of course, we've had some money back, so we haven't got so much money invested in this deal, and it lifts the ROI to 48%. So we've got an increase in the rent and a decrease in the investment there. It's quite a good way of increasing your ROI, taking some money out and then pushing that over to another deal. So then with the further advance then, no legals, you're saving 1,500 instead of refinancing to another lender. The product fee is only on the further advance amount only. Great way of recycling cash, next to if it's just like works and you're just with one lender. 6-month rule is actually applicable, so you need to be in this facility for 6 months so you can get further advance. And of course, you can't do any heavy works. Of course, if you did do any heavy works, the value that comes back out to the property would see that you've done heavy works and then you log you into the lender, and then you've gone against mortgage guidelines there. Through. Is there someone's mic on? There we go. Great. Okay, so some USPs about Kent Reliance. They offer product transfer, further advances up to 80%. They've been known to do them up to 85%, so it does change time to time. So we just need to keep an eye on the market because sometimes things change, and therefore our expectations be different. Okay, so no experience with Kent Reliance. If you want to buy a property of 6 units on a HMO or a 6-unit multi-unit block, you won't need any experience to do that, which is brilliant. So does anyone know what this is? Raise your hand if you do.
Japanese knotweed?
Japanese knotweed, yes, indeed. So Japanese knotweed is a brilliant thing to know about because a lot of the time people will think this is terrible when it's actually very treatable as an invasive weed in your property. So when you've got properties, it's good to know about Japanese knotweed because obviously if you're buying properties with Japanese knotweed, it could be a negotiation tactic, but of course you need to know about the cost of eradicating it and treating it. So I'm going to share with you a deal that I did with Japanese knotweed, a deal that probably wouldn't have done if I didn't know anything about it because of what a valuer will tell you. If you go to buy a property on a mortgage and it's got Japanese knotweed within the boundary, they will probably scare you off by giving you a nil valuation on the property. So if you can see in the title plan there, there's number 87. If you guys can see my cursor here, this is number 87. Now, at the time, I'm going to take you back. I had just bought this property, refurbed it, refinanced it, and we got all of our money back out. We're very happy with it. And then this property came up for sale next door, number 85. So we didn't mess about. We just offered them what we paid for number 87. We thought that we just won the deal so much that we're just going to offer them, asking price, and we did. We offered them 100,000, and we went to Kent Reliance. We got a valuer out to value the property, and the valuer came back and gave us a nil valuation and said the property was worth 0. Couldn't give us a value basically because it was outside of the lender's policy. Now, we were a bit taken back because we'd been out in the garden, we didn't see any Japanese knotweed, but the valuer was insistent that there was Japanese knotweed in the boundary of the property. So we went back out there, we couldn't see it. We went back to the valuer and we said, could you show us where it is on the boundary? Now, in number 87, when we bought it, the absolute title was from here to the front, all the way to the back gate. So actually what was happening was the property number 85 actually came with more land. There was Japanese knotweed just here. So what we did, we went to the estate agent. We said that the valuation has been returned to zero. It's got Japanese knotweed. And we renegotiated the purchase price to 75k firstly. We bought it cash. We then split the title, so it went to the back gate, just like the one we already owned. And then we refurbed the property, and then we went back to Kent Reliance to refinance. And now, today, we own this land here, unencumbered. So it doesn't have any finance on it at all. It goes back quite far, actually, in real life. And with this one, actually, 87 that we already owned, this land here that came as extra, we actually had a possessory application when we bought it, because the owner had an affidavit signed to say that they've been tending to this land for over 20 years. So we've actually now got an adverse possession claim going in for this land. So we're now going to hopefully have an absolute ownership of the land soon, and we're going to merge these two parts of land together. Further up here, property owned adjacent, they've actually done the same thing, and they've got a development on the back here now of residential flats because there's good access in a lane here. So we're hopefully going to do the same thing. Who knows? We'll have to do some remediation of the Japanese knotweed. I know that much, but if the numbers stack up, then it'll be a deal, and if not, we'll sell it. So just a little creative strategy there. So when we exited that deal, then we had a valuation done of 180,000, remortgaged at 75%, and we managed to pull out 20,000 and still keep the property and still make a profit. So all in all, when you're looking at the equity we left in as well, there was a net profit of 65,280, and that was a single let. So it was an infinite return on investment, and these deals can be done. They're about now. I know rates are a bit more expensive right now, but the opportunity to pull out that level of capital from an uplift is still about. Okay, so we've gone over the 6-month rule. Now we're talking about criteria with lenders on legals. So if we're buying HMOs and we're buying properties to use them as serviced accommodation, we might be buying commercial property, such as hotels or high street buildings, or we might even be looking at offices. And what you'll find is these lenders will have a closed legal panel, which means they'll give you a list of maybe 10 solicitors that you might choose from in a list to act for either yourself and the lender, or to just act for the lender. And then you could maybe use your own solicitor as well. Usually if you're having two solicitors, one for you and then the lender's chosen solicitor, your solicitor will have to have 3 SRA approved managers. And if you go on the SRA register, you can check if your solicitor has that many SRA approved managers. But if you choose joint representation, it can be a bit quicker because you've got one firm acting for you and the lender, but you've got 2 individuals in that firm, one acting for you, one acting for the lender. And sometimes that can be a lot more efficient. So with the EPC legislation changes now, it's actually been thrown out. But it's worth mentioning because lenders are actually giving discounts to applicants that have properties that have an EPC rating of A to C. So before they threw it out, they did have, well, we still have a requirement to have an EPC rating of E, but they did have it out there in the press that they would require an EPC rating of C by law by 2025 for all new tenancies, affecting landlords essentially. And then they were going to then also by 2028 make sure all ongoing tenancies were an EPC rating of C. But that's been scrapped now for the time being. But as with government, things do change. So currently, EPC ratings of A to C, banks are offering cheaper mortgage products of up to 0.5% cheaper. So it is worth upgrading your properties. 1, because you might have to soon, and 2, because we can make a saving there on rates. We can get refurbishment, buy-to-let products. So I think we mentioned earlier about the bridge to let. So that's really how it's titled there. You've got 0.84 a month if you're borrowing the top loan to value, and it's just with a product fee of 0.75. So your exit then, probably the most important part of the bridge to let. You can do it on a standard property with the rates just there with a 2% product fee, and also HMOs just there. So working with brokers then, I know some of you already do. So things to prepare if you're looking to go into a mortgage application would be your income documents, proof of address, your proof of funds would be good. And of course, if you've got those funds from somewhere, eventually the lender's going to want to see the trail of those funds. So it's probably important if you've got a gift from someone, you might need the bank statements at some point. And if you've refinanced the property, they might want to see a completion statement. If you've done a refurb to a property, please keep your invoices, please keep your receipts, because if you're then refinancing on the new value, your lender will probably want to see those invoices and receipts as well. It comes into anti-money laundering guidelines where they'll want to check these, and it could happen at the start, it could happen in legals, so make sure you have them. If you're doing a refurb, please keep the schedule of works, so you can also match that up with your invoices and your receipts. If you're buying a new HMO, it's quite important that if the property was made a HMO before Article 4 came in, you'll want to get a certificate of lawful use from your vendor, especially if you're buying cash at auction and you didn't get that certificate of lawful use, you'll then have to put it through the planning portal to get the certificate of lawful use, which can still take 4 weeks. So also, you'll need a fire risk assessment done on a HMO. That'll come up at legals, as you will with the gas and electrical safety certificate. So have these documents to hand, because it will save you a lot of time later. So if we're doing an exchange delayed completion, that is where we're exchanging and we're going to delay the completion for another day where we might have done a refurb in between, for example, or got planning for something in some cases. But if you're going to do a refurb to the property, you can then actually go to a lender and get a 75% mortgage on the new value on purchase. So you might have put down 5 or 10% deposit to exchange, and then you might delay the completion so you can then refurb it and then exit straight onto a mortgage product at over 100% of the purchase price sometimes. So very suitable for below market value deals, very suitable for refurb deals. You can therefore avoid bridging finance, avoid all those setup costs, avoid all that monthly cost. So we can negotiate the terms with the vendor on timescales and penalties for the exchange delay completion as well. So then looking at options, if you're doing rent to rent and you've secured some options, now let's say that your option has matured over time and it's now worth a lot more than it was when you took out the option. What we can do is we can make sure that we've got the RX1 that we did at the time of the rent to rent and therefore your option. So you'll need legal advice at the time. But the main thing is that you've got a valuation done at the time the lease was taken out, because this will evidence to the lender that it's an arm's length transaction and you could have bought the property at the time at the agreed price, but now the valuation has escalated organically. So when you have that, it gives you the ability to then get a 75% mortgage on the new value straight away, and that can also include, you know, later if you've developed the property beforehand, that valuation will be included for your refurbishment as well as any organic growth in valuation. So again, you can complete sometimes on more than 100% of the purchase price. So again, avoiding bridging finance to reduce that cost of borrowing there. If you didn't get a valuation done at the time, some lenders might accept a retrospective valuation. Now that is basically a valuation done based on the time where you took the lease out, the lease option. So if we're looking at semi-commercial, Hampshire Trust are great for day one exits, by the way, but they're also a specialist buy-to-let lender, which means that they're charging less than full-blown commercial lenders. So what we can do for semi-commercial properties, we can approach a specialist buy-to-let lender sometimes to get a cheaper rate. Now, they will have harsher criteria, of course, than full-blown commercial lenders. Particularly, they like to have 2 access points. It just increases their chances and reduces their risk in repossession of being able to lose control. So if you've got two access points in repossession, a lender can either sell off the one unit or the other, or they can sell off which goes first, but it enables them to do that with two access points. So with a 50-50 split, that's probably what you'll need in terms of valuation. They like to see sometimes 60% of the valuation being in favor of the residential parts. Now, they don't always require experience. They've just sometimes got a minimum loan size for people without experience. So as well, the commercial part, if you're using that towards affordability, we'll need to look at the lease, because a lot of the time, if the lease isn't strong, if they've got not much time left on there, or they haven't been in place for so long, then it might not be used towards affordability. So it's always good to note that down. And if you are looking at funding for a semi-commercial, get a copy of the lease in place on the commercial part. So Hampshire Trust, they don't require debentures of loan sizes up to 2 million. So it avoids you then needing to get a letter of non-crystallization if you're looking to get another mortgage on another property held in the same limited company. For larger loans, they might not need a personal guarantee. Experience is basically having 12 months landlord experience. So if you have that, you're classed as experienced. They've got a 10% overpayment facility. Now, if you see a lender with a 10% overpayment facility, it basically means that they will allow you to repay over up to 10% of the original mortgage balance back every year. So you could really clear your mortgage off in 10 years. So instead of taking capital repayment, where you're obliged to make them capital payments, you can have the choice of doing that and still clear your mortgage off in 10 years without penalties. So Hampshire Trust, they've got a minimum loan size of 100k, and we can cluster that as well. So we can use multiple properties. If you've got £30,000 properties and you've got 10 of them, well, that's 300k worth of value there. So you'll easily hit it. Overseas borrowers, they'll give an extra 1% on their product fees there. And with HMOs and multi-unit blocks, they don't have any maximum units. So if anyone's doing any big stuff, then, Hampshire Trust are a good lender. So with evidence and documentation then for serviced accommodation, holiday let, of course, they're not going to be rented on a long-term AST. So you'll need to sometimes get a projection letter from, Sykes Cottages, Guest Ready, cottages.com, or Holiday Cottages. And these will give the lender a better idea of how they'll calculate the affordability. So I'm seeing a lot of people actually buying properties that have been B&Bs before, and they're C1 in use class. And a lot of people are converting them then to like apart hotels where they've made them either studio apartments or like one-bedroom flat type configurations, and they're servicing them to contractors or to holiday makers. And the issues that come with those type of transactions is that people are doing this for the first time. They will struggle to get an investment valuation based on, that building. So you'll still get a bricks and mortar commercial valuation on the building, which probably won't be impacted too much by refurb. Maybe a bit, but not massively, because it's still a commercial building. And without a lease in place, they're just going to value the bricks and the mortar. So what you would need to do really is go to a lender for a 90-day valuation of the bricks and mortar for at least 12 months, or if you bought it cash, you'll just keep your cash in there for 12 months. So you've got 1 year's accounts, because then once you've got 1 year's accounts, you're an owner occupier in that commercial building, you can then get a commercial investment valuation. And when you then do that, you'll then really capitalize and be able to recycle your cash back out. Because really in cash flow, they're very, very high in strategy. So some lending factors, credit scoring, credit searching, depending on the lender, your scoring might not make any difference, but searching is usually always a factor where they'll notice any defaults, CCJs, anything like that. Now we can keep track of that on Check My File, where it breaks down which agencies have reported what adverse credit you have. Now, not all agencies will report all adverse credit times. So sometimes, you can go to a lender that might only, report to Experian, for example. So it's useful to use Check My File because it breaks it down. And stress testing is also a factor with lending. Of course, if your rental isn't high in yield, it might struggle on affordability. Minimum incomes for a minority at the moment. Strategy is a factor. Experience is therefore a factor with certain strategies, and also property and tenant types. You know, if you're doing social housing, sometimes these tenants are classed as vulnerable, and that can sometimes be a factor there. Now, with social housing, if they are classed as vulnerable, vulnerability also cascades down into severity. So DSS is widely accepted as probably at the start of social housing spectrum. But then you then get social housing leases with like Serco, for example, and Serco might house the lowest spectrum of vulnerability, such as asylum seekers, which are not that vulnerable in comparison to other social housing types, and they're more widely accepted. So if you then have social housing types where they need more support, such as nightly support, then there'll be less lenders interested to lend on that just because of reputation risk. But there are still plenty of lenders out there. You just move to more commercially type lenders where the loan to values are a bit lower and the interest rate can be a bit higher there. So yeah, if we're looking at social housing, it's a great strategy. So yeah, do keep that in mind. And yeah, I'm welcome any questions now at any point from anyone.
Okay, thanks for that, Joe. So I suggest people just raise their hand. Is there anyone who's got any questions? If people's cameras aren't on, I won't be able to see if they've raised their hand. Anybody want to ask a question, please? Unmute and fire away. Unmute and fire away.
Hi guys, can you hear me?
Can just speak a little louder, please.
Great, thanks. So I've got...
Oh, that's Agnes. Right, okay.
Hello. I've got two questions actually. First one would be, what's your plan to get rid of that Japanese knotty, by the way?
Sorry, Agnes, I can't hear.
Oh, sorry. What is the plan to get rid of Japanese knotty?
Oh, right. Okay. So you just need the Japanese knotweed plan. So what happens is you go to a Japanese knotweed specialist, and they would do a report on the Japanese knotweed. Now, the thing is, if the Japanese knotweed is more than 7 meters from your boundary, then you won't need any report at all, which is why I split my title, because I still got it now. I've got no treatment plan on it. But if it is actually in your boundary, it's still a good deal. You know, you just need to cost in that Japanese knotweed plan. You know, it could be 1,500, it could be 5,000. It just depends how much you've got of it. The report might cost you £500, and the plan, you know, might cost you another 1,000. It's not going to be that expensive, but also it's just still one to factor into your costs there.
Sure.
I'm buying a house at the moment, incidentally, that had some a small amount of Japanese knotweed in the adjoining house, who actually owns my house, the house I'm buying as well. By coincidence, it's near a train line, so there's quite a bit. He got a survey done, and I think he paid about £300 for it. And they have to treat it 3 times a year for 3 years. And I think it will cost about £3,000 at the most. So what Joe said stacks up with my recent experience. If the amount of Japanese knotweed in volume is more, then I could only assume it might put the price up a little bit. Okay, back to you, Agnes, for your second question.
What is the rate of success?
What is the rate of what? Sorry, Agnes.
Sorry, what is the rate of success to get rid of it?
Oh, right. Well, yeah, no, you can definitely get rid of Japanese knotweed indefinitely. Like on a development, you've got to dig it out and bury it. If it's just in your property, you can just treat it. Yeah, it's guaranteed to go. It's just how long it takes. Every case is probably going to be different. So yeah, the chemicals they use will definitely kill it eventually. But it is one of those things that do take a while. It's not like, you know, you can just spray it with a bit of weed killer and it'll go. You know, it is actually tough stuff. So it will, like Clive said, you know, 3 visits sounds about right. And even with the chemicals that they use, it'll still take that amount of visits. And that's why there's that process in place. So yeah, I think as investors, we can take advantage of these things that will affect your normal house buyer. You know, most residential homeowners, they went out to buy property and it came back with Japanese knotweed, they'd probably walk, you know. So that therefore us as investors can take advantage of that scenario and maybe capitalize from it.
So, I've got another question. Can you hear me okay?
Yeah,
Yeah.
yeah. I can.
Okay, so it's real life example. So my company has 5 properties, okay? Two of them, so property number 4 and 5, I bought in 2022, okay? Both of them were bought with mortgage. So I was roughly buying them at the same time. So the second, it's not with the same lender. So the second property, my broker, which I used at the time, found me a deal. However, that deal did not include 10% overpayment clause at all. And I was told by my broker, this is the best I could kind of, can get, just because my company has a big loan from myself. So I own some properties in a personal name. I just transfer them, to the company. Okay. So that's what I was told. And I was a kind of surprised because that's the first time when I came across a lender. This is just standard buy-to-let lender, taking the 10% overpayment method away. And that deal, it was a fixed deal for 5 years. And it came with the charges, including the valuation and everything, around 2.5 thousand. So just wanted to see from your experience, well, is that a kind of normal thing, or rather my broker was not that great and, he rather cared about the fees which he got paid from the lender and from myself.
Yeah, I think if I was going to stab a guess at it, right, I'd probably say that he just didn't want to wade through all the options, because the thing is, there's thousands of lenders out there. So I don't believe that there wouldn't have been a lender out there that didn't give a 10% overpayment facility. It would probably just taken them a lot of time to wade through your next options and illustrate a lender that it's probably easier to say it's not available. But yeah, no, if you were going to do the deal again, you could find a lender without a 10% overpayment with a 10% overpayment facility. So just give me a call if ever that day comes again, and I'll sort that for you, because there's loads of lenders out there. But the thing with that is that a lot of lenders did take it away. So there's not all lenders will do it, but there's still a lot of lenders out there that have that. So it's definitely one you can have and a string to your bow.
Kensington mortgages, by the way, and what is allowed, there is so I can overpay over the 5 years in total £5,000. However, they will not deduct it from the capital. So, and this is interest only mortgage. Okay, they will take that 5 grand. However, only at the end of the fixed term, they will deduct it from the capital, meaning I still will be paying the same amount of interest on it, which was another thing which kind of struck me. But next time I just give you a shout, basically. Thank you.
No, that's fine. Yeah, it's better because when you have the overpayment facility, they should then calculate the interest again. It renews monthly, and then you'll have that calculated for you on a reduced balance. But also, Agnes, and for everyone as well, I've put my details in the chat there. So unlike most company directors, I am available directly. So if you want to call me, you don't have to set up any appointments. Just give me a ring. Obviously, I am busy, so if I miss any calls, I may call you back. But yeah, I am available. So call me, email me, anytime. And thank you for sharing, Agnes.
Thank you.
Okay. We've got Dermot. Please unmute and ask your question, please.
Yeah, thanks, Clive. Great presentation, Joel. Thank you for that. Very informative. A lot of it was right over my head, so that means it's good. I just need to do a bit more learning on it, I think. One question I've got for you. I've got an apartment at the moment that has got 65 years left on the leasehold. I tried to remortgage it recently and I couldn't get anywhere. Just wondering if you know of any specialist lenders that will get involved with that. It's got an absentee landlord involved as well, so that's makes it a little bit more complicated.
What's the situation with the landlord? Because the lease isn't a problem.
Okay, well, the landlord went bust several years ago and disappeared, so they're just not there.
Everything okay with the freeholder?
As far as I know, everything's okay. It's just complicated by the fact that the landlord's absent, if you like.
Okay, fine. I'm assuming then that there's someone that's got some sort of right to sell this lease, so you're going to be able to complete on the vendor side, yeah?
I don't know if there is. I think that's the problem. They can't get hold of anybody to negotiate with to extend the lease.
To negotiate. Well, the thing is, with the extension of the lease, it's nothing to do with the. Is this the lease that you already own, or is this a lease that you're going to look into buy?
It's a leasehold property, so it's
You're
the
buying it.
leasehold that needs extending, if you like. It's just that we've got nobody to negotiate with.
So you own it
So,
right now, yeah?
So I've got it on a mortgage at the moment.
Okay.
There's not much left to pay on it, but I'd like to take out some of the cash that's in there, if you like, and use it elsewhere.
Fine. Well, just so you know, right, two sides then. The lease is fine. You should be able to get a 20-year term as it is now, okay?
Yeah.
As long as there's 45 years remaining at the end of the term, low leaseholds are fine. Now, again, something you're going to have to speak to your solicitor about. When you own a property for 2 years, under Section 42, you're able to serve notice on your freeholder to extend the lease. Now, there's actually a nominal time frame where that freeholder needs to respond to you in. Otherwise, you can buy the extension at the nominal rate, which is it's like written in stone, I'm sure, by government. So you have that ability then. If you speak to a solicitor that knows what they're doing, and if you don't know one, I'll point you in the right direction. But yeah, leasehold extensions are a massive strategy. Because again, if you're up against residential home buyers and you're looking to buy properties with low leases, it's going to deter a lot of buyers. So as an investor that knows what they're doing, if you can then get in, contact well, this is the other thing, right? So of course, you have a 2-year process before you can serve the Section 42. In your case, I'm assuming you've got it already, the 2 years behind your belt. But if
Yeah, I've had it for about 15 years, something like that.
Excellent. But yeah, for the benefit of the group, if you're looking at buying a low leasehold flat, obviously you're not going to have those 2 years. So what you can do, if your vendor has owned it for 2 years, they can serve the notice and then they can assign it to you. So you don't need to wait the 2 years. So that's something that you can use and speak to your solicitor about. But for yourself, Dermot, I think, yeah, just speak to the right solicitor and you should be able to, serve a Section 42 notice. And if they don't, I think it's 2 weeks they've got to respond, or 2 months, it's 2 something. I know roughly just the process there. So whatever that timeline is, after that, you can just buy it at the nominal rate.
What I'll do, Joe, then is if I email you separately to get all of your solicitors, sounds like more of a specialist than mine is, and then yeah, if you can give me the details, I'll contact them separately.
Yeah, no problem at all. I will do, no problem. Thank you for sharing that, Dermot.
No worries, thank you.
Thank you, Dermot. If you'd mute again, and Liliana, please.
Okay, Joe, thank you for the presentation. Although I jumped in a little bit late, so hopefully I'll listen to the recording. I have 2 questions actually regarding of the mortgage. I'm very new to the property business, although I had in the past a property here in UK. As you can tell, I have a strong accent, right? But now I'm in a position that I don't have, I'm not mortgageable, I suppose, and I don't have an income. And I want to run the service accommodation strategy, and I have a potential person who offered to have his name on the mortgage. I'm trying to understand because it's completely new things for me. So is it that possible? How is that possible? I don't know. Yeah, please tell me, please.
Yeah. Okay, so with serviced accommodation, to get a mortgage, they will require you to have some income. So of course, if you have zero income at all, then yeah, in isolation, then that might be difficult. But you could still do it in theory if you had deposit funds available. You could procure that on short-term funding. However, if you have got a JV partner, I think you're mentioning there.
I'm yet to understand how it works because I just had this offer literally a few days ago, so my head is spinning, and I need to understand before I will find the property. No, before I start, because there's no point to find the property and me not to be able to be on the mortgage or whatever, how it works, because then, so how is that possible? A stranger, let's say, although he's not really quite a stranger, to be on the mortgage, whether it's with me, will I be on the property deeds?
Yeah, so who's putting in the money out of you two? Are you both putting in the money or is it just you?
We can put both. I can add the deposit, but I have been told that the same person can put the deposit as well.
Yeah, you can. Yeah. So if you were going to open a limited company and you're going to have 50% each and you're going to put in 50% of the funds each, then it's only one person required to hit criteria out of the two. So you don't both need to be employed, but one of you can then, one of you can then be employed to hit the mortgage criteria there. So what I would say is if you're doing service accommodation and you're not in a major city, then maybe try and get like a house so you can get contractors in there. So you don't,
That's the
hotels
plan.
can't really, yeah, contractors.
Yes.
Yeah, hotels can't really compete with houses because they've got loads of space. In like a 3-bedroom house, you could probably get 5 contractors. But in like 1-bedroom flats, sometimes if you're not in a major city and you're going for the contractor market, you can't really compete with the travel lodge. They're charging next to nothing. So it's just one to consider. But most of my SA clients do the best when they've got big houses because there's just no competition. A business sends their workers to a large house and it's so much cheaper. So yeah, no, I think you're on the right lines and you're definitely mortgageable with that structure. So well done.
Well, I said I will consider the offer, but I don't know yet what it entails. So the second question is, as a second option, if I will set a LTD company, put some money in, and then to purchase the property on that LTD company, how does it work? How long do I need to have the amount held in that LTD company? I don't know.
Great question. So the thing is with a limited company, a special purchase vehicle, they were really designed at the same time they brought out Clause 24, which was they were going to stop higher rate taxpayers owning property in their personal name from deducting mortgage interest as an expense. So then was born, there was always limited companies you could buy properties in, but it became more common at that point. So when you've got a special purchase vehicle, a limited company specifically designed to just hold property, it's actually just a tax wrapper. You don't need to own it for any certain amount of time. The company actually is preferred to be brand new because when a company is brand new, a lender can underwrite that much quicker. If you've had like a business before and you've now kept the limited company open to it might not be trading anymore, but it might have been trading in the past, and you've kept the business open to then just buy properties in it, it's actually more of a risk to a lender because it's got skeletons in the closet, there's previous trading. So actually a brand new limited company is perfect. You don't need to have any experience on that.
That's so great news. So literally I can put the money in. The company could be a brand new company. Well, it will be a brand new company, and I can apply for mortgage straight away.
Yes, literally you can. Yeah.
Okay, I'll save your number and contact details, and you'll hear from me. Thank you.
Great. Thanks, Lillian. Thank you for
Thank
sharing
you.
that. Cheers.
Okay, thank you, Lillian. I noticed, Dermot, you still got your hand up. Have you got another question? Oh, no, it hasn't. Okay, I would have let John go first anyway, but John, please unmute and ask. John, we can't hear you yet.
It's all right. Maybe I can unmute John. Oh no, he's not.
No,
muted.
he's unmuted. John,
Yeah.
you are unmuted.
Yeah, I
I'm
can't hear.
afraid, John, we
John,
can't hear you. If you are plugged in to headphones, it may be a problem. I don't know.
John, if it doesn't work, if you want to put your question into the chat box, I can pick that up and come back to you if that's all right.
Has anybody else got any questions, please? I just wanted to ask a couple of observations, really. My observations were, and it may just be because of the actual live examples or real examples you used, but you obviously do quite a bit of business with one or two people, the Hampshire and the Kent Reliance and people like that. Is that because you just find them the best, or were they just happen to be the ones you used in these cases?
Yeah, no, it's just who we used in these cases, really.
Yeah.
Yeah, so to be honest, like Kent Reliance being a specialist lender without a 6-month rule, HMOs, multi-unit freehold blocks, but they have a product transfer facility out there. It's quite new actually. Specialist lenders are now seeing it as what it is a bad thing when they don't do product transfers. So
Yeah.
even when sometimes specialist lenders without product switches came up cheaper over the 2 or 5 year fixed, I was also always telling my clients that it could actually be more, it could be cheaper getting a more expensive product slightly because the lender has a product transfer. So, because obviously there's upfront cost, isn't there, to change back onto a fixed term if you need to remortgage. But no, not really. I'm whole of market. So every deal that I get, I'll look at every lender in the country and we'll assess it based on that.
Yeah. One of the things I liked about your presentation was quite a few references, especially in the second half, to joint ventures and working with other people, and even your reference to having an exit strategy, something you often don't hear from either solicitors, trainers, or brokers. And possibly I'm just making a speech here and you'll just agree with me in the end, but hopefully you might be able to add a little bit because of your experience. I do think it's very important to have good joint venture agreements, partnership agreements, shareholder agreements, whatever you want to call them. And although it sort of flies in the face a little bit, one of the tips I was given by an older cousin who was a very successful solicitor is always have an end date to any joint venture agreement, and that end date has to be the sale of that property. Has to be that he was adamant, and he even excluded the right for the other partner to the joint venture to buy from the other. He excluded that most categorically. Now, of course, the one thing people don't like about selling property is that it gives rise, they lose the income from that property, which they like. If it's a long-term investment, why give it away and start again? And also paying the tax on usually capital gains tax. So have you got any comments on that, please?
Yeah, absolutely. I mean, most recently, I've actually invested with my dad. He wanted to get out of work, and I wanted to get him a bit of a pension to start building that up because he wasn't really in property. And I did a joint venture agreement with my dad. You know, I wouldn't not do a joint venture agreement with anyone because I've been in business since I was 16, very young age, and when you're that young, you run into things head first and you make mistakes. And I'm quite fortunate to have made mistakes that didn't cost me greatly. In the end, I was managed to get out of them and start again. So yeah, I would just say that to be honest, it's actually a great addition that you mentioned there as well, Clive, about your family member there with the solicitor, where they were saying that they wouldn't even have either party buy either one out, because that leaves room for people to then exploit the situation, get undervaluations and present the purchase as more lucrative their side, but hiding the value, from the other person. So I think that's a great extra clause, one that I don't hear many people talk about actually. I think it's brilliant. So yeah, I would just say that a stop date to it is a good one. Stop dates are used for all sorts of things. They're used for exchange delay completions, lease options, but also joint venture agreements are a great reason to use a stop date. So yeah, if you're doing a JV agreement, make sure there's a stop date in it, and you won't regret it later, because like any business transaction, there's got to be an exit, and a joint venture agreement might only cost you £1,000. Like, I bought a scaffolding business, and that was in 2021, I think. And basically, because I was putting all the money in, I basically written into the agreement that until I've had every penny of my investment back, I could buy the other person's shares back for £1. But for all intents and purposes, because I'm not a scaffolder, I do this. He needed to be a shareholder for all sorts of reasons, so he was the head of the business. But for that reason, I wasn't comfortable not being able to buy the shares back for £1 because of that. So yeah, you just write it in, share purchase back for £1, and there's loads of things that you can do to, cover off any risk that there is in a business transaction there.
Yeah. Okay. Well, I might come back in a minute, but I'll let John speak. Can we hear John yet, please? No. If you want to type your question, if you haven't done so, we'll have a look at that after we've spoken to Beverly.
As well, Clive, I was going to say, can everyone see my contact details there?
Yes, I will distribute it, but it is in the chat.
Great. Cool.
And it will be on the notes that I send out. So there'll be no worry about getting your details. But thank you. Yeah, Beverly, go ahead, please.
Yes, hello. And thank you for the presentation tonight. I've learned quite a lot, taken quite a lot of notes. There's something that I missed that you went through on one of your slides, where you discussed doing an HMO purchase or getting a mortgage from Kent Reliance, and then you talk about a further advance. Now, what was the circumstance that made you apply for the further advance from Kent Reliance? What?
Yeah, good question, Beverly. Thank you. So in this case, the client had bought the property on a HMO basis, 75% loan to value, and they were then in a situation where they'd spent some money on the property and they wanted to do a further advance to get some of their money back out, so then they could then buy another property. So because the HMO managed to increase the rental, because they increased the quality of the rooms and then they managed to get a higher rent, they were then able to justify a further advance, which again gives some of their money back, although it increases the cost of the finance. Where they increased the rent, it sort of covered off any extra cost of the interest on the further advance as well. So not only did it not really impact their cash flow too much, it actually increased their return on their investment, because they got most of their investment back then from the further advance. So they were able to then spend that money on another deal, and then go again and get another return on investment on that cash elsewhere,
So the further advance was on the equity gained from improving the value of the property and the rent, etc.
Yeah, absolutely. Right. Yeah.
Okay. Got it. Thank you. That's
okay. No worries. Thank you.
Joe, I'm going to ask another question. Firstly, I'm going to make the point that I do at the end of most of my webinars, when I have, because for most of us, these topics are quite difficult, and some of the advanced tax topics that I've covered have been certainly difficult for people. I think the important thing, as I always say, is that these sort of webinars make you aware of possibilities, make you aware of options. You can park those in your mind, or at least always have a feeling that there's a solution if you find a person who's able to find a solution for you. So that's my comment. But my sort of question, I suppose, is during the webinar, I realized why one of the most stressful parts of buying a property is dealing with brokers, probably, and that's often because you don't visit their office, although you might, and you tend to approach it by, not you, but one tends to approach it, or is required to approach it by sending particulars of the property, what funds you've got, and all your personal circumstances, and then somebody like yourself might suggest one or perhaps two solutions. I think the difficulty for me is sometimes that when you're presented with a solution, it's actually hard to grasp them. It's hard to understand them. It's hard to just really, and also you wonder, is this just one option, one solution, or are there others? And is the broker giving you perhaps more of a personal service, for want of a better phrase? Could you just talk to us about how you would approach sitting down with, and because you're so far away, probably on Zoom, which is fine, and actually, taking us through that process, because I know you are busy, etc.
Yeah, absolutely. So the thing is, right, because I'm a property investor as well, I'm not like a normal mortgage broker where people come to me and they're just like, I need some finance. Can you give me a quote and an illustration? We're not that formal in that sense. So I'll always give my observations like I would as a property investor. And of course, the other thing is as well, indirectly to that, if I didn't give my observations as a property investor and I ignored what I thought, I would just be entering into an application where I'm putting my time in, where it's going to cause problems later on down the road. Like someone called me today and they said that they were looking to buy a property at auction. And I remember they called me 2 weeks ago and they told me that that property had structural issues. So I noticed that and I said straight away that, can you get a structural report? Because most brokers would have ignored it and seen what happened on the valuation, right? And then when the valuer goes out in 2 weeks, and then they're like, structural, can you get a report? Because a valuer will always want that. They would never, challenge their professional indemnity cover against what they perceive as structural damage. So if you get that in advance, you're saving then 2 weeks after the valuation is back, so you can go straight forward and then, put it into the schedule of works and make it happen quickly. So what I would say is when people come to me, we have the same sort of meeting. Not everyone really wants to do a Zoom meeting or a FaceTime, but I'm happy to do them, especially if people ask. And therefore, if we go through as much as we can, we've got the screen share. I can then go through illustrations bit by bit. It's actually, what I find is it's more beneficial because we can record the screen share, kind of do that in person. The client can then go back and then go through the advice. And I've got nothing to hide. I'm happy for that to be recorded and, gone through on Zoom. So yeah, what I find is that being nationwide, because, I've got mortgage brokers from London to, North Wales way, I've got quite a big network. A lot of my self-employed team are everywhere. We're taking on a broker in Scotland. We're taking on another one in London soon. So yeah, the distance doesn't really matter too much. Like I'm going to Cambridge PIN tomorrow. I do the mortgage update there every month. Even though I'm so far away, I do a lot of traveling. So yeah, the distance isn't that much of an issue, but I understand what you mentioned there about the professionals. Sometimes going into their office, it's nice to have that personal service, but everyone's personally respected. My team are great. They're very, very friendly. I don't really have a business where I've got staff in and out every month. I don't think I've had a new member of staff must be 6 months now. We're taking on someone else now, but that's not in replacement, that's an addition. So we've got very high retention. I look after my staff very well. So the chances are you'll be if you're dealing with us, you'll be dealing with my team, you know, for the next 20 years or more. And a lot of my staff are also my family. My two sisters work in the business, so does my brother. So they've worked for me for a very long time, and therefore the personal service is always there. You know, we have quite a good rapport with our customers.
Yeah, very good. Thank you for that. I must admit, I wasn't aware that you had agents around the country. So that's something very valuable and new to me. And although I'm sure you do just basic homeowner residential mortgages, I know your speciality really is, as you said at the very, very beginning, you really serve property investors rather than homeowners. So I think that that's very important to note as well.
Thank you.
So unless anybody's got any more questions, those were really my observations. And, you know, I have heard that before. You do that, and it was a whirlwind the first time, and it was a little bit clearer this time, actually. So that's been very, very good. So I'm going to call it a day there, because you don't know this yet, Joe, but because we didn't record it from the beginning, I'm going to try and twist your arm in your own time to just do that first 10 or 12 minutes for us. But, you know, I know you're nodding sagely there, but you're probably cursing me under your breath.
Thing is, Colin, we can do another session again. You know.
Yeah. Okay.
Yeah.
One or the other. I appreciate you offering to do that. So without further ado, thank you, Joe. I have been really churned up the last week or two with these offers coming in, and not knowing, really strangely burying my head a little bit in the sand, because I found it quite daunting to deal with the broker side of things. So I think for me it's been really, really good. And to get that personal contact has been great. I
can see John commented as well, actually. So I can answer this quick for John. He said he's having difficulties getting a commercial valuation on a 4-bed conversion into a 6-bed HMO, and he was wondering if I had any ideas on how to navigate this. The project cost was 165. He's invested 100k already after Craig Property pulled out, citing profit margins. He needs to raise an extra 65k off the GDV to pay off the existing balance and complete the work. But all the bridging companies keep using the existing value, despite, this is easy. I think this will be an easy one to solve. So yeah, we can go off the GDV. We just need a full development product. I think what they're doing is giving you a refurb product where they're going to value the property mid refurb and only give you 75% of that. But really, if you go to a full development lender with an asset manager, they'll come in and see the cost of works remaining. And as long as the GDV is healthy and we've got profit on cost of 15%, then we'll be able to get you development funds and to get you out of that, John. So if you call me tomorrow, I'll sort that out for you, okay?
Thanks again, and thanks, John, for getting that message through. I didn't see it because I think you'd sent it direct rather than to everybody, so I didn't see it. Okay, thank you everybody for joining tonight. Thank you, Joe.
Thank you, guys.
Thank you.
Bye.
Thanks. See you. Bye-bye.